Have you ever entered a breakout trade only to watch the market reverse and hit your stop loss? Or maybe you've noticed that the market often takes out a support or resistance level, traps traders, and then moves in the opposite direction. The truth is that these moves are not random. They are often caused by institutional traders hunting liquidity. In this video, I will show you a powerful 1-minute trading strategy based on liquidity sweeps, an institutional trading concept used to trigger stop losses, trap retail traders, and create high-probability trading opportunities. In this video, you will learn the market maker model trading strategy, how to trade external liquidity sweeps step by step, how to trade internal liquidity sweeps step by step, how to identify high-probability trade setups on the 1-minute chart, the exact entry, stop loss, and take profit rules, how to find trades with a risk-to-reward ratio of 1 to 10 or higher, real chart examples with complete trade breakdowns. This strategy can be used on the 1-minute and 5-minute time frames. It is suitable for both scalping and day trading, and it works across all financial markets, including Forex, stocks, indices, commodities, and cryptocurrencies. Before we get started, make sure to hit the like button, subscribe to the channel, and turn on notifications so you don't miss any future trading videos. Now, let's get started. Before we dive into the trading strategy, you first need to understand what a liquidity sweep is. A liquidity sweep occurs when the market targets stop-loss orders placed by traders around obvious support and resistance levels. For example, the market may create a clear support level. Many traders place their stop-loss orders below that support. The market then breaks below the support, triggering those stop losses, but quickly closes back above the level. This is known as a bullish liquidity sweep. The opposite can happen at a resistance level. The market creates a clear resistance level, breaks above it, triggering buy stop orders and stop losses from sellers, and then closes back below the level. This is known as a bearish liquidity sweep. These are called external liquidity sweeps because they occur at major support and resistance levels that are clearly visible to most market participants. There are two main types of external liquidity sweeps: buy-side liquidity sweeps and sell-side liquidity sweeps. Let's start with buy-side liquidity. A buy-side liquidity sweep occurs when the market targets liquidity resting above a significant high, such as a previous day's high, a weekly high, or a level where multiple highs have formed at the same price. Many traders view these highs as breakout levels. As a result, they place buy-stop orders above them, expecting the market to continue moving higher after the breakout. At the same time, traders who are holding short positions often place their stop-loss orders above these highs to protect themselves if the market moves against them. This creates a large concentration of buy orders above the level. When enough liquidity builds up, institutional traders may push the market above the high to trigger these orders. Once the liquidity has been collected, the market can reverse direction as large sell orders enter the market. This process is known as a buy-side liquidity sweep. Instead of chasing the breakout, smart money uses the pool of buy orders above the high as a source of liquidity to enter positions at favorable prices. This is why many breakouts fail shortly after taking out a significant high. Now let's look at sell-side liquidity. A sell-side liquidity sweep occurs when the market targets liquidity resting below an important low, such as a previous day's low, a weekly low, equal lows, or the bottom of a trading range. Many traders place sell stop orders below these lows, expecting the market to break down and continue moving lower. At the same time, traders who are holding long positions often place their stop-loss orders below these levels to limit their risk if the market falls. As a result, a large pool of sell orders accumulates below the low. When sufficient liquidity is available, institutional traders may push the market below the level to trigger these orders. Once the liquidity has been collected, large buy orders can enter the market, causing price to reverse and move higher. This process is known as a sell-side liquidity sweep. Look at this chart example of the Australian dollar versus Swiss franc on the 1-minute chart. As you can see, the market was trending up, which means buyers were in control. The market then reached this area and reversed, creating a resistance level. After that, price retraced back toward the same resistance level. Now look at what happened next. As soon as the market reached the resistance level again, it got rejected. There is something important you should pay attention to here. From the moment the resistance level was first created until the market retraced back and tested it again, approximately 30 candles formed. This is one of the conditions of this strategy. Ideally, you want at least 25 to 30 candles between the creation of the level and the retest. Since this setup meets that requirement, it qualifies as a valid trading opportunity according to the rules of the strategy. The rejection candle also provides a very tight stop loss, which is exactly what we are looking for as scalpers. Remember, you should never risk more than 1% of your trading account on a single trade. However, when your stop loss is tight, you can achieve a much higher risk-to-reward ratio, which is essential for long-term profitability. Now let's place the trade and see how much risk-to-reward this setup offers. You enter the trade at the close of the rejection candle. Your stop loss goes just above the highest point of the rejection, and your target is the next support level. As you can see, this setup provides approximately a 1:9 risk-to-reward ratio, which is exceptional. Now let's see what happened next. As you can see, the market continued lower and eventually reached the target exactly as expected. Look at this chart example. As you can see, the market was trending down, which means sellers were in control of the market. The market then reached this area and reversed, creating a support level. After that, price retraced back toward the same support level, made a liquidity sweep below it, and then got rejected. That liquidity sweep is our trading signal. There is another important detail you should pay attention to. From the moment the support level was first created until the candle that made the stop hunt, approximately 32 candles formed. This is exactly what we are looking for. One of the conditions of this strategy is to have at least 25 to 30 candles between the creation of the level and the liquidity sweep. Since this setup meets that requirement, it qualifies as a valid trading opportunity. The idea behind this rule is simple. The market spends enough time consolidating before revisiting the level, and when the move finally happens, it often becomes much more explosive. Now let's place the trade. You enter at the close of the rejection candle. Your stop loss goes below the lowest point of the liquidity sweep, and your target is the next resistance level. As you can see, this trade provides approximately a 1:12 risk-to-reward ratio, which is exceptional. Now let's see what happened next. As the market moved higher and reached this resistance level, you move your stop loss to break even. At this point, the trade becomes risk-free, and you simply let the market do the work. Look at what happened next. As you can see, the market continued moving higher and eventually reached the target, providing approximately a 1:12 risk-to-reward ratio. Will every trade reach the target? Of course not. Sometimes, the market will reverse before reaching your final target. However, once your stop loss is moved to break even, you are no longer risking any money on the trade. Psychologically, this puts you in a much stronger position because you know that the worst-case scenario is a break-even trade, while the best-case scenario is a large winner. And that is exactly what we are looking for with this strategy. Small controlled risk and occasional big winners that can more than make up for multiple losing trades. Look at this chart example. This is the British pound versus Canadian dollar on the 1-minute time frame. As you can see, the market was in an extended downtrend. Remember, one of the conditions of this strategy is to have a clear uptrend or downtrend before the setup forms. In this case, we have a strong bearish move, and then the market reaches this area and reverses, creating a support level. Now look at what happened next. The market retraced back toward the support level, broke below it, and then closed back above it, creating a liquidity sweep. Technically, you could take this trade. However, I do not recommend it because the stop loss would be too large. As I mentioned earlier, one of the keys to this strategy is finding entries that provide a tight stop loss. If the stop loss is too wide, simply ignore the trade and wait for a better opportunity. Now look at what happened next. The market creates another liquidity sweep, this time with a small doji candle. This setup is much more interesting because it provides a tight stop loss. There is another important detail here. From the moment the support level was first created until the market retraced back and performed the liquidity sweep, approximately 34 candles formed. This is exactly what we are looking for because it shows that the market spent enough time consolidating before revisiting the level. Now let's place the trade. You enter at the close of the doji candle. Your stop loss goes below the lowest point of the liquidity sweep. and your target is the next major resistance level because we expect an explosive move after the stop hunt. Why? Because the market was clearly trending down and then spent a significant amount of time consolidating before sweeping liquidity below support. This often signals that sellers are exhausted and that a strong move in the opposite direction may be about to begin. Now look at what happened next. As you can see, the market rallied strongly and eventually reached the major resistance level. This single trade provided approximately a 1 to 24 risk-to-reward ratio, which is an exceptional result. Will every trade produce this type of return? Of course not. However, this example shows why focusing on tight stop losses and high-quality liquidity sweeps can be so powerful. A few large winners like this can easily compensate for multiple small losing trades. Internal liquidity is different. In an uptrend, price may break below a resistance level that has turned into support after a breakout, creating the impression of a trend reversal. However, the market quickly closes back above the level, creating an internal liquidity sweep before continuing higher. In a downtrend, price may break above a support level that has turned into resistance after a breakdown, creating the impression of a bullish reversal. However, the market quickly closes back below the level, creating an internal liquidity sweep before continuing lower. The key difference is that internal liquidity is a continuation signal, while external liquidity is a reversal signal. External liquidity targets major highs and lows, and often leads to a change in direction. Internal liquidity occurs within the trend, and is often a sign that the trend is ready to continue. Look at this chart example. This is the British pound versus Japanese yen on the 1 minute timeframe. As you can see, the market made an impulsive move, followed by a retracement and then another impulsive move lower. This support level was broken during the downtrend and turned into resistance after the breakout. Now look at what happened next. The market retraced back toward the resistance level, broke above it, and then closed back below it. This is a clear internal liquidity sweep. The liquidity sweep traps buyers who entered on the breakout above resistance and triggers the stop losses of sellers who entered too early. Once the market closes back below the level, it signals that sellers are regaining control. Now let's place the trade. You enter at the close of the rejection candle. Your stop loss goes above the highest point of the liquidity sweep, and your target is the next major support level. Now look at what happened next. As you can see, the market moved lower and eventually reached the target, providing approximately a 1 to 8 risk-to-reward ratio. Trades like this appear frequently in the market. One reason they can be so powerful is that they occur in the direction of the prevailing trend. Instead of trying to predict a reversal, you are simply waiting for the market to sweep liquidity and then continue moving with the trend. Because the setup is already aligned with the downtrend, it generally has a higher probability of success than counter-trend trades. This is why trend-following liquidity sweeps are often some of the best trading opportunities you can find in the market. Now look at another chart example. Look at this chart example. This is the euro versus US dollar on the 1 minute timeframe. As you can see, the market made an impulsive move downward, followed by a retracement. This support level was broken during the downtrend and turned into resistance after the breakout. Now look at what happened next. The market first broke below the support level that had turned into resistance and then closed back above it. At that point, breakout sellers were trapped because the market failed to continue lower. But the story doesn't end there. Shortly afterward, the market broke back below the same level and closed below it once again. This trapped the breakout buyers who entered when the market moved back above the level. As you can see, both sides of the market were trapped. First the sellers, then the buyers. This is a clear internal liquidity sweep. The market sweeps liquidity on both sides before committing to its real direction. Now let's place the trade. You enter at the close of the candle that closes below the level. Your stop loss goes above the highest point of the liquidity sweep, and your target is the next major support level. Look at what happened next. As you can see, the market continued lower and eventually reached the target, providing an excellent risk-to-reward ratio. This is why internal liquidity sweeps can be so powerful. They trap traders on both sides of the market, clear liquidity from the chart, and often create the fuel needed for the next impulsive move. Look at another chart example. This is the US dollar versus Swiss franc on the 1-minute time frame. As you can see, the market was trending up, which means buyers were in control. The market then retraced back, forming a clear resistance level. Now look at what happened next. The market moved higher and broke above the resistance level, but then closed back below it. This created a trap for breakout buyers who entered the market expecting the price to continue higher. But the story doesn't end there. Shortly afterward, the market moved higher again, and this time closed above the resistance level. This trapped the sellers who entered after the first false breakout. What happened here is called an internal liquidity sweep. The market trapped traders on both sides before revealing its true direction. And that is our signal. Now let's place the trade. You enter at the close of the candle that closes above the resistance level. Your stop loss goes below the level, and your target is the next major resistance level. Now look at what happened next. As you can see, the market continued moving higher and eventually reached the target, providing at least a 1-to-8 risk-to-reward ratio. This is a perfect example of why internal liquidity sweeps can be so effective. By trapping both buyers and sellers, the market collects liquidity from both sides before making its real move. When you learn to recognize these traps, you can position yourself on the same side as the smart money instead of becoming part of the liquidity being targeted. Now, I hope you enjoyed this trading strategy. If you found this video helpful, make sure to hit the like button, subscribe to the channel, and turn on notifications so you don't miss any future trading videos. Thank you for watching, and I'll see you in the next video.